So every strategy and by consequence, every fund manager has good days and bad days. Warren Buffett was rogered in the 1990s for ignoring technology stocks. Dr. Michael Burry for betting against the housing market. Prashant Jain and his value investing principles received a lot of flack in 2018-19 for investing in PSUs. But one person who has borne the brunt of it is Mr. Saurabh Mukherjea for his advocacy of coffee can investing. It's the same coffee can strategy जिसकी कोविड से पहले लोगों ने काफी प्रशंसा की थी. But now it's like
एकदम इन्होंने वक्त बदल दिया, जज्बात बदल दिए, जिंदगी बदल दी.
And I'm not exaggerating here. I mean, look at some of the comments people have been posting on different social media platforms. Which begs me to ask the question, is the coffee can strategy still relevant or has it suddenly become outdated? It's something we'll try to decode in this video along with some theories, some data, some statistics. We'll also see where the potential gaps are in the current strategy, how can one improve it based on what we have learned from other videos on my channel, and that's where the filter coffee can phrase in this video's thumbnail comes in. And finally, if I were to start today, which are those aromatic, roasted, nutty stocks I'll have in my own coffee can portfolio? Let's begin. Now, I already have a video on coffee can investing. I think this was like the second video on my channel. So I won't repeat any of this, but just to give you a quick overview, what is coffee can investing? And very simply, it's a long-term, generally passive strategy that involves investing in 10 to 15 high-quality stocks and holding onto them for a prolonged period of time, which is typically 10 years or more. The term itself was coined by Mr. Robert Kirby in the early 1980s when he discovered that one of his deceased clients, who had invested in many of Mr. Kirby's buy suggestions, had never really exited any of those positions, which ultimately helped the client build a massive corpus. So essentially, coffee can investing is a buy and forget strategy, and because a few positions will end up dominating the portfolio, investors should expect a slightly unbalanced portfolio construct and should have the patience to not meddle with the system. Now, we Indians were introduced to coffee can investing via this book, Coffee Can Investing, The Low Risk Road to Stupendous Wealth. And the most impressive table was this one on page 34, Exhibit 6, which shows us that the CCP portfolio has outperformed the Sensex in all 17 years of examination. Even on a per stock basis, the book in Exhibit 147 onwards presents a sort of histogram showing the up and down frequency over a 25-year period. And one can clearly see the Sensex having a lot more negative periods as compared to CCP constituents like Asian Paints, Marico, HDFC Bank, Relaxo, etc., giving us the picture that coffee can investing does work and it has historically worked in many countries, including India. Now, all the data I have presented must definitely make you wonder that if the coffee can approach is so smooth and aromatic, then why is it facing so much flack today? Well, a large part of it has to do with one big flaw, which is the coffee can method is very agnostic, or rather, it's very ignorant to valuations, which is something Mr. Mukherjea is known to have upheld in many of his interviews and articles. Now, one side of the argument is that there is always a premium one needs to pay for quality, and it's a point I absolutely buy. Yes, companies that have stability, growing sales, good profits, high ROCE, strong moats, absolutely they do deserve a premium. But when we look at the CCP's valuation trajectory, notice what was in the 22 to 25p range until FY14. That same metric has since jumped to up to 3 times by the year 2021-2022. The impact of this is clearly visible in the yearly performance of Ambit's coffee can portfolio as problems started emerging from the year 2021 onwards when the CCP's price earning multiple was in its 60s and the portfolio found it exceedingly difficult to beat its benchmark. The Nifty 50 index whose P ratio was less than half of that. This gives us lesson number 1 in our understanding of coffee can portfolio, that is, avoid entering, or if not avoid, then resist allocating a large chunk of money into the coffee can style of investing if the portfolio's P ratio is more than 50. I even mapped it on a per stock basis for the massless consistent compounder portfolio, and please pay special notice to the P ratios in the 2012 to 2014 period, then compare it with 2017, 18 and 19, and then again look out for the multiple in the 2021 to 2023 period. I'm sure you can see an accelerating pattern here, and over time, these CCP stocks have become more expensive to acquire, which means there is almost no safety in valuations, and unless everything is going perfectly, there is a fair chance that the coffee can portfolio or a stock within the portfolio is likely to underperform the index, at least in the short to medium term. In fact, with the stock markets at an all-time high, there is this looming fear of a steep correction in equities, which has led to many investors opting for a cautious wait and watch approach. Of course, finding a parking spot for your money is easier said than done. And if your choices are between a savings account, a liquid fund, or an FD with a big bank, I'm quite certain I have a better alternative for you. For instance, a fixed deposit in a small finance bank gets you a high interest rate. This number currently goes as high as 9.1%, and because these are bank FDs, your money is safe with deposits up to 5 lakh rupees insured with the DICGC, the Deposit Insurance and Credit Guarantee Corporation, which is an RBI subsidiary. Understandably, identifying a suitable FD with a good interest rate can be a bit tedious, which brings me to Stable Money, the sponsors of today's video and a platform where you can compare interest rates of over 200 banks and book multiple FDs in multiple banks without having to open a new savings account. The platform also offers instant withdrawal, giving you immediate access to your money. And because the stock market looks a bit expensive now is definitely the right time to invest in FDs by locking in those high interest rates. So do check out the Stable Money app using the link in the description below and let me know in the comments what you think of this platform. Now, the coffee can investing process is a series of 5 steps, so let's examine them and see where improvements can be made. It all starts with step number 1, that is the identification of high quality and well-established companies, which is surprisingly the easiest part of the process. This is done by picking only those companies that have been in business for at least 10 years, so that's the well-established part. And secondly, we consider only those companies that have been suitably generating a return of at least 15% on its capital employed, which gives us the high quality bit. Now, on a standard screener, applying the 15% ROCE criteria and a regular market cap condition yielded me a little over 450 companies, which seemed to include almost everyone, private biggies like TCS, Infosys and HUL, and also public sector enterprises like LIC of India and Hindustan Aeronautics Limited. But then this single filter was never going to be enough, and the evidence of that is the sales growth column, which for some established companies like Britannia, Divi's Lab, Hero, Motorcorp, Dabur, etc. has been less than impressive. This brings us to step 2, wherein we filter this list for a minimum sales growth of 10% at different points over the last 10 years, and our original list of 457 companies is now down to 81, with each of these companies not only showing a high return efficiency on their capital, but also consistency with some progressive growth in their sales numbers. We find recognizable names here, including Avenue Supermarts, Titan, Varun Beverages, ICICI Lombard, etc., many of which are a part of the Massless and Ambit CCP list as well. And as a portfolio, the top 15 companies from this list have grown sales by 20%, profits have jumped 26%, the average ROCE is also 26%, and as an equal weighted portfolio, it would have delivered 72.6% in annualized returns, making this portfolio one of the more prominent wealth creators over the past 5 years. Now, I'm sure you've noticed there aren't many banks and NBFCs in this list. Actually, there aren't any banks or NBFCs here, and that's because the ROCE is not an appropriate metric when wanting to measure institutions that rely heavily on financial leverage. Instead, the ROE, the return on capital, is a better way of keeping track. And if you're keen on adding financial firms to your coffee can portfolio, then select companies with a loan book growth of at least 15% and also a minimum ROE percentage of 15%. Anyways, I'm keeping financial firms out of this study for now, but from what we have seen over the last 3-4 years, it's very much in our interest to have some additional considerations that I'll put forth in step 3 of our process. Actually, step 3 is not one step, but a combination of a few sub-steps. The first exercise is something we've already looked into, that is, we don't want the really expensive stocks in our portfolio. Again, I'm not saying that investing in every high PE stock is bad, but we've seen these instances with companies like Asian Paints, which have been rather flattish over the past 3 years. Now, as a portfolio, we said a PE of 50, but because we are selecting stocks for our filter coffee can portfolio, and this is very subjective, but I'll prefer companies that are valued at a PE multiple that is presently lower than its historical 3-year PE ratio. Of course, this brings down the pool of companies, and in our case, we are down from 81 companies to just 15 companies. At this point, what's really useful for us is to understand which are the companies that have missed the cut and did it make sense to exclude them. So that's 81 minus 15, 66 companies that were excluded, and here are some of them. Okay, let's start with Bharat Electronics Limited, and at least from a valuation point of view, I don't think something bad happened here, as we ended up excluding a company that's generally in the 20 to 30 P band, but was now being valued at a multiple of 56. Same applies to Varun Beverages, that has broken away from its P ratio banding of 50 to 65 and is now at a multiple of 97. The same is the case with Polycap, with Supreme Industries, whose P has just shot up in the last 2 years, Titan and Avenue Supermarts, and don't get me started on Dixon Technologies, which at the time of recording this video was priced at an earnings multiple of 190. We'll of course have to assume some selection errors, some cracks in the system, but to ensure the bad stuff doesn't creep in, let's look at sub-step number 2 in our filter coffee can process. Okay, so we'll select only market leaders. Actually, the word leader is a bit strong, also a bit restrictive. So if you find a prominent number 2 or number 3, a challenger basically, then even that can be considered. For instance, in our refined 15 stock list, PI Industries is a worthy challenger in the agrochemical space. I think it's number 3 in terms of sales. Tata Elxsi is very good at what it does with EV related software and design. Sona BLW is in the top 3-4 amongst auto ancillaries. ICICI Securities, well, let's keep them aside for now given the delisting saga that's going on, and it's something I covered in my newsletter as well. Natco Pharma, Bikaji Foods, Zen Technologies with their combat training and drone solutions, Tanla, Safari, well, most of them seem to be a leader or a challenger, which is what we need. But yes, there are some exceptions. Similarly, Monarch is a small size stockbroker. Banaras Hotels has just 3 or 4 properties, and then there's the Brightcom Group that's besieged with dozens of legal and regulatory problems of their own. My point is, since we want only sustainable companies that can persist for the next 15-20 years, it's better to have only the leaders or the top challengers from this list, which brings it down to 11 companies, and that's absolutely fine. And the final subpoint under step 3 is to do with the size of the company. Okay, so I've kept it at the end, but well, figure this. So the CCP portfolios of Ambit and Massless are mostly large cappers, right? And not just large cappers, many of them are giants amongst India's biggest companies with market capitalization running into lakhs of crores of rupees. But here's the surprise, nowhere does it say a coffee can portfolio has to have only large companies inside it. In fact, our own list of 11 companies, the biggest market cap here is PI Industries with 64,000 crores, which gives it a rank of 147 amongst listed companies in India, which technically means every company in our filter coffee can list is either a mid-cap or a small cap, and officially the last 3, Safari Industries, Nesco and Finiotex Chemicals, are actually microcaps. This part is important because unlike what many people think, there are actually 3 different kinds of CCPs. The first is our conventional coffee can portfolio, which includes the tried and tested large businesses. So blue chip companies like HDFC Bank, Asian Paints, Bajaj Finance, Titan, Trent, Pidilite, etc. The second variant is the moonshot coffee can portfolio, and this includes mid-caps, small caps, and even micro-cap companies that come with this inbuilt expectation that while you lose your entire capital in some companies, some others will be big winners, becoming 10 to 100 baggers over the next 15 to 20 years. And the third kind is the blended coffee can portfolio, which is a mix of conservative and moonshot companies aimed at giving investors both stability and tactical opportunism, but without having to actively manage this portfolio. And speaking of tactical opportunism, I hope you've subscribed to my newsletter where I featured a diverse range of stories, including Sami Hotel's remarkable turnaround post their IPO, BLS International's revenue surge following their acquisition in Turkey, Zaggle's impressive growth and international ambitions, Sky Gold's continued rise fueled by lower gold prices and increasing consumer demand, and of course there's a story on Raymond Lifestyle and how its recent demerger has created a potential mispricing opportunity for contrarian investors. All this is a lot of research, a lot of reading, but it's all worth it if you can see these ideas translate into real profits. If you haven't subscribed to my newsletter, then kindly do so now and also tell your friends about it. Okay, so the identification part is almost done, and step 4 is all about having an additional layer of proof on the growth and sustainability of these businesses. Now, in my opinion, the best way to understand this is by reading the quarterly earnings transcript and related materials. For example, I've been labeling PI Industries as an agrochemical business so far, and that's pretty much how Screener, Ticker Tape, Sovereign, and other platforms tag them. But when one reads the latest earnings transcript, you'll be a bit surprised to know that 50% of the company's inquiries and over one-third of its new products are currently in the non-agrochem space, which includes electronic chemicals, semiconductors, advanced polymers, etc. The company is also building an integrated CRDMO business, so it's getting into the pharma business for which they have committed a decent amount of capex, and this new initiative is likely to give much better margins than the agrochem business. My point is the PI industries we see now is going to be very different 4, 5, 6 years into the future, and that's what we as investors should be looking out for. That is, what are the company's growth plans? Where is the capital being deployed? Is it likely to be a leader or at least a top challenger in its chosen space, etc. This activity somewhat connects with the process steps Ambit or Massless follows, wherein qualitative parameters like leverage, quality of management, governance standards, etc., and also things like competitive advantages and consistency of growth is used before coming up with a final list of coffee can stocks. I personally think our filter coffee can system handles many of these points, but that being said, I'll request you to read up more about each of the 11 companies in our list, or if you plan to create a different list for yourself by tweaking some of the variables. I'm sure you'll learn a lot in the process. And the fifth and final step is to invest. As I said earlier, we're looking for a small number of high quality companies. So anywhere between 10 and 15 companies should fit in perfectly within the coffee can investing framework. Okay, so we have 11 companies so far, and it's perfectly possible that after you've done with step 3 and especially step 4, a couple more companies might have moved out from this list. For example, the filter we ran in step 3, where the current P should be lower than the industry P ratio, well, that's not something I'm very keen on, because if these are quality companies we are trying to identify, then typically their P multiple has to be a bit higher than the industry average, right? At least that's what I think. And even with step 4, okay, let me give you an example. Take Nesco Limited, for instance. Now, this is a company that has an IT park, the Bombay Exhibition Center, and maybe some food division. But all of these are capacity constrained, as in there is no operating leverage here, which means it's difficult for me to understand how Nesco's revenues can grow by 15% or at least 10% for many more years. This is, of course, my point of view. Yours might be different. But the point is, before investing, you should have a solid reasoning on why you are getting into that stock. Okay, so for step number 5, we're looking at a small set of companies, 10, 15 companies at max. We're also looking for some diversity, and surprisingly, the 11 companies that have propped up in our list are super diversified across sectors, so look out for something similar. Number 3, very important, hold on to companies for an extended period of time. I'm talking about 10, 15, 20 years or more, and don't let fear and greed get the better of you. Feel free to average up over time. And honestly, in my case, in my own portfolio, I have a couple of stocks wherein I doubled up the shares after the stock had gone up by 10 times from my initial buy price. There was a time when I would have labeled this act as sacrilegious, but over the years I've realized that averaging up has helped me a lot more than averaging down. And finally, do keep a track of the companies in your coffee can list. Remember, I use the word company, the business, not just the stock price, and this is best done by reading as much as you can, which includes the quarterly earnings transcript, news, articles, and research reports, and it most definitely does not include Instagram or YouTube shorts. So please avoid the flim-flam, the duplicitous daily stuff. Remember, you're not looking at the next 10, 20 days, but it's more like the next 10 to 20 years that you are interested in. To conclude, let me go back to the question we started this video with. Is the coffee can strategy still relevant? And I'll say it's now more than relevant, with the style of investing being the easiest and the most formidable way of creating wealth. After a few false starts in my early years, I've been using the coffee can style for a few years now, and especially on mid-cap, small and micro caps, and the result has been more than satisfactory. So try this approach out, do your research, and I hope 10, 15, 20 years from now, you and I will be thankful that we heeded to this advice. As always, thank you for your time. Share this video with others, and I'll see you very soon. Until then.